Anchor investor, when an IPO has a strong anchor investor participation, it is generally viewed as a positive signal. But an important question arises after listing. What happens when these anchor investors become eligible to sell their shares? They will sell the shares. SEBI has recently published a study on the exit behavior of the anchor investors in main board IPOs. This study covers around 240 IPOs listed between April 2022 and October 2025. So with 167 IPO tracked for a full year. Now let us understand the important points through the practical FAQ mode. I will explain in detail what is an anchor investor. An anchor investor is generally a qualified institutional investor who is allotted shares in an IPO before the issue opens for a subscription by the other investors. Clear? The anchor investor is a qualified institutional investor who is allotted shares in an IPO but before the issue opens for a subscription by the investors. This is a definition. So the presence of the reputed institutional investors can provide confidence to the market because it indicates that institutional investors are willing to participate in the IPO at the determined anchor price. So, however, the anchor participation should not be understood as a commitment to hold the shares for the long term. We cannot expect. Are anchor investors allowed to sell their shares immediately after listing? Answer is no. Anchor investors are subject to a specific lock-in mechanism. 50% of the shares allotted to an anchor investor are locked for 30 days from the date of the allotment, while the remaining 50% are locked in for 90 days from the date of allotment. So their shares are subject to lock-in. The entire anchor allocation cannot become freely tradable immediately after listing. Clear? Then what happens after the first 30 days? After completion of the 30-day lock-in, the first 50% portion becomes eligible for share. But this does not mean that the anchor investors are necessarily sell all those shares immediately. The distinction is very important. The expiry of the lock-in is only creates an opportunity to sell. Whether the investor actually sells depends upon the factors like the market price, investment strategy, future expectations, and their portfolio requirements. Does the end of the 30-day lock-in automatically result in a fall in the share price? Not necessarily. The SEBI study indicates that the extent selling by such anchor investors matters. Where selling was relatively limited, the price movement around the first unlock was also relatively limited. This is the study. However, where the substantial portion of the anchor holding was sold soon after the 30-day lock-in period expired, the study observed greater downward pressure on the share price around the particular period. So, but we should be careful here. This does not mean that anchor shelling alone causes the price fall. Share prices are influenced by several factors, including market conditions, company performance, and news flow, and selling by the other shareholders. So various parameters influences. What happens when the 90-day lock-in expires? At the end of the 90 days, the remaining 50% of the anchor allocation becomes eligible for sale. So interestingly, the SEBI study did not observe the same degree of the price sensitivity around the 90-day unlock was observed around the 30-day unlock. So there was a difference, 30-day unlock and 90-day unlock. This was the study observation. So this suggests that the first unlock may receive a greater market attention, particularly where selling is concentrated. Do anchor investors normally sell all their shares immediately after the lock-in? Answer is this perhaps the most interesting finding of the SEBI study. Will go to that study. The data indicates that the anchor exit generally happens gradually over a period of time rather than immediately after 30-day or 90-day lock-in expires. For the IPO tracked for 1 year, cumulative anchor exits were approximately 3.5% by 30-day, 9.3% by 60-day, 18.5% 90 days, 34.4% by 180-day. So 50.7% by 365 days. This was the observations. So the bigger message is that the anchor story does not end when the lock-in expires. The institutional shareholders base, the institutional shareholders can continue changing throughout the first year after listing. So does every type of institutional anchor investor behave in the same way? Answer is no, may not also. The anchor strategy makes a difference. The SEBI study indicates that the foreign portfolio investors, mutual funds, showed a different exit patterns. By the day 365, FPI had exited approximately 60% of their aggregate anchor allotment, whereas the mutual funds had exited approximately 38%. So the analyzing an IPO, it may not be enough to simply ask how much anchor investor has come. It is useful to ask what exactly should ask. Who are the anchor investors? What could their investment horizon be? So this is important. Is a high anchor allocation always be positive? Is a positive sign for the company. Anchor participation can certainly be a positive factor at the time of the IPO, but the companies and investors should not assume that anchor investors will remain as a shareholders for a long term. So an anchor investor may have completely a different investment objective and holding period from the promoters or a long-term shareholders, that depends. Therefore, the anchor participation should be seen as an initial institutional participation, not as a guarantee long-term institutional ownership. May happen, may not happen. So what should the company planning an IPO learn from the SEBI study? So there are several lessons. For the company should not focus only on the building a strong anchor book. Second thing is the management should understand that the institutional investor base may change considerably after listing. There is no guarantee. So third, the investor communication becomes the communication becomes particularly important. The communication is important after listing. And the fourth one is the company should be prepared for changes in the institutional ownership, not only around 30 day or 90 day, but throughout the first year. They should be prepared. Should the investor be worried whenever a anchor investor sells? Not necessarily. When an anchor investor selling shares does not automatically mean that there is something wrong with the company. Institutional investors may sell for several reasons. They might be having a legitimate reasons like a portfolio rebalancing. Another example, profit booking. One more example like fund redemption requirement, or investment mandate, or change in the valuation, or better investment opportunities, we can say elsewhere, changes in their investment strategy. So many reasons. So the investor should not interpret every institutional sale is a negative sale. No, it is not a negative signal. So the important question is why the shares are being sold and what is happening with the company's fundamentals at the same time. They should think. What is the biggest takeaway from the SEBI study is that the anchor investor investment is not an end of the IPO story. So it is the beginning of the potentially changing the institutional shareholder base. The lock-in create first two important milestones, 30 days and 90 days. But the SEBI shows the study, the data showed that the anchor exist can continue progressively for many months after listing. So the company should be prepared for a gradual transition in an institutional ownership. That will happen, may happen. So what should the investors look at after an IPO? So instead of looking only at the anchor list, investors should monitor changes in the institutional shareholding, trading volumes around unlock periods, and the company fundamentals, valuation compared with the IPO price, financial performance after listing, and shareholding pattern disclosures, and whether the institutional selling is isolated or part of a broader trend. So the anchor investor data should be treated as a one piece of the information, not as the sole basis for investor decision. So here the conclusion is that the important lesson is very simple. Anchor investor can create a confidence at the IPO stage, but their presence does not guarantee long-term support for the share price. So the current framework provides a suggested unlock 30 days and 90 days. However, SEBI's recent study shows that the actual exit can continue progressively over the period following months also. So for an IPO bound company, the focus should not stop at obtaining a strong anchor book. The real challenge is after listing. Can the company maintain the anchor confidence, deliver the performance, and build a broader and stable institutional investor base? This company should question. This is an important question. So here the disclaimer is this video is for educational and informational purpose only, and should not be considered investment advice. Regulatory provisions and market practices may change, so viewers should refer to the latest SEBI regulations and official disclosures before taking any decision.